Good morning, my name is Dr Przemysław Kwiecień. You are watching XTB Weekly Trading webinar. Today we are going to have a look at economic outlook, because last week we had a bit of a correction attempt on Monday, which was very brief and quickly negated. However, there were some concerns that maybe this economic situation that we're looking at currently is not going to persist, and maybe even we're going to face stagflation. Even though markets quickly rebuff these concerns, maybe it's a good idea to take a deeper look to be prepared just in case. But let's start with our typical refresher of what the markets are looking at Monday morning. And yeah, first of all, we had just on Friday we had records on S&P 500 and Nasdaq 100 as I said, markets very quickly rebuffed these concerns, and yeah, with the flood of US dollars on Wall Street, these trends are very persistent. Today in the morning we had quite a bit of move in Asia. On one hand, we had a rebound in cryptocurrencies, then again we see real problems for Chinese stocks that are struggling under another regulatory issues, this time referring to the education sector. We'll take a look at these charts in a few minutes. Then again, we had coffee that was a real star of last week. We have the first situation when the price of coffee exceeded 200 in 7 years. As it's the case with coffee, very often it was mostly the issue with supply worries regarding weather, regarding other factors that may limit supply of coffee going forward. We covered coffee in our news section, so you're welcome to visit it and scroll. For the past couple of days there were at least few mentions and analysis, so you're encouraged to do that. And this week, this is going to be mostly FOMC on Wednesday, US GDP on Thursday, and some very relevant quarterly reports, which we'll discuss at the end of towards the end of this webinar. So let's start very quickly with technically the key event of last week, which was the ECB. Like I mentioned last Monday, the ECB raised their price target to 2% from 1.8%. And obviously they had to follow it with some kind of action. However, markets were a bit disappointed, as they expected the bank to maybe herald more QE or something like this. However, what they did, they reshaped their interest rate guidance, mentioning that they would like to see inflation at 2% around the middle of their projection, and not falling below that level towards the end of projection, in order to even consider interest rate increases. So in other words, it looks like the ECB is saying, look, we are really not thinking about increasing interest rates. And the last time when this target they mentioned here in green occurred was 20 years ago. So you can imagine now, with the economy so much weaker fundamentally, it looks really like the ECB could stick with this negative rate for very long period of time. What it means for the dollar is that markets are really right now focused on the dollar side of the market, because with the euro, like I said, nothing's going to happen with the ECB. So the question is, if the Fed follows through on their initial discussion of the tapering this week, and they will need it, the US dollar will need it in order to test this support zone, because otherwise this move, which was actually triggered after the June FOMC meeting, looks like it's losing some of the momentum. So unless the FOMC goes really hawkish this time, we could see some attempt recovery attempt on this market. All right, let's move to the story of the week, and let's take a look at these arguments, stagflation arguments. Is this really a threat? So first of all, why are we discussing this? Well, markets obviously are doing great, especially US markets are setting record after record, and even when you think maybe this time a correction is going to occur like last Monday, it's being negated very quickly. So obviously with valuations at the sky high level, a return of a period which was a very dark period for equity investors wouldn't be something that would be taken lightly. As you can see here, for 9 years, where this stagflation period was officially seen as something that happened in the US, 5 years were negative for real returns, so that includes adjustment for inflation. So obviously it's not something that investors would like to see going forward, and therefore even a remote risk of stagflation shouldn't be completely dismissed. So why is this the case when actually right now the demand in the US is so strong? As you can see here, this is something that I showed last Monday. Consumer demand in the US is right now not only above the levels we had before the pandemic, which is here, so as you can see it's much higher, but it's also higher than the trend would indicate. So if you extrapolated this pre-pandemic trend, you can see right now that consumer demand in US is so much higher already. This is because unlike a typical recession when your income declines on average, this time we had income increases, and these increases were very substantial. Normally, as you can see, this trend is quite I would say smooth, moderate. It would take many years for personal incomes to reach these levels that were reached recently due to these Biden and Trump checks and other sort of payments, or extra claims, or extra unemployment benefits. All of this support actually that was obviously fueled by debt, which then again was purchased by the Fed, was directed at the US households. So obviously they are spending money because they have it. So the question right now is, what happens if when this impulse fades? All right. So obviously we had these big periods of stimulation, but right now it's about to end, and all these subsidies are now being done, and these special unemployment benefits are about to be about to end very soon. On that depends on state, but in general, most of this extra aid is about to end in September at the latest. At least that's the plan. So the question obviously is, what's going to happen with the demand? If it plunges, then it may leave the US economy with higher prices, as inflation is already above 5%, and suddenly lack of demand, even though right now we have so much excess. But that's not the only reason. The other reason is that the Chinese are actually already tightening. This is Bloomberg China Credit Impulse, and as you can see, it's quite correlated with some other indicators like copper prices, like PMIs. And as you can see, after a period where Chinese stimulated their economy, now it plunges. That's quite obvious because from China perspective, when they are mostly looking at the rivalry with the US. What they want to do is to think long term. So they're thinking, look, why are we about to stimulate the economy right now when we can benefit from the US stimulation, and we can actually tighten at home and balance our economy a bit, and leave some room for maneuver when US crashes. So this is, I think, what the China does. And even though, like I said, in the morning today we had major declines in China, so this could look strange for at least on the surface, when you see, okay, Chinese markets doing so weak, even though it's generally accepted that China is economic winner of all this situation because it suffered much less than the US and other Western economies. Actually here, as you can see, at least looking at the Chinese comp, which is Hang Seng China Enterprise Index, these stocks that are being traded in Hong Kong. as you can see here, this index is actually closer to the pandemic lows than to the highs that we had earlier this year. So this market's already in the bear market, and the US market is actually setting record after record, as you can see here. Yeah, just a slight pull down today and above 4400s last Friday. So yeah, so Chinese they're already tightening, and that's the other reason why, you know, some could be concerned that in a few months, when, you know, this extra demand evaporates in the US and with tightening in China, you could actually have a hit to global demand. The other reason is that normally when there are expectations of robust growth in economic growth in the world, you see US dollar weakening. Not something that we are witnessing today. We already discussed euro dollar, and here you can see Australian dollar versus the US dollar, and the divergence with the S&P 500. So you can see that in 2018 we had such a situation where the Aussie was sliding and the stocks were rising for some time and then crashed, and a similar situation in 2020, and right now again we have divergence. Obviously it doesn't mean that the US stocks are about to crash as it happens 2 times, because these are just 2 observations, and you know each of these situations is different. However, for some it could look like a warning signal. And finally, the PMIs where on one hand we have very strong PMIs across the board, showing a strong economic performance, but then for a few months already companies are signaling, okay, we are having a lot of orders right now, but we cannot fill them because of many constraints. And then again there is a concern that, okay, we'll be left with higher prices and with pricing pressures, but at some point something can break. So so there are some concerns. Yeah, like I said, this economic stimulus that was applied, especially in the US, is something that we never seen before. So yeah, there is a risk that when this artificial demand fades, we don't know what's going to happen. It's not a typical economic cycle that we saw playing out many times in the past. Each economic cycle is different, by the way, but this time, because of this level of intervention, it's you know open sea, and yeah, while I wouldn't expect this strong demand to persist, the question is how it's going to unfold. We really don't know, and you know we need to stay open-minded. But what's important right now, I think, from the market perspective, is that market is flooded with liquidity in the US. Like I said, in China they are tightening, and you already saw how it impacts Wall Street, how it impacts the Chinese stocks. Whereas in the US you had this situation where the Treasury, they reduce their cash holdings, the Fed prints more and more dollars each month, and as a result the over liquidity is at a record high. So since investors, they do not know what to do with the money, why would they pull away from the market? So the way I see it is that unless these problems are obvious, unless they already see, you know, they are falling from the cliff, they're not going to react. So obviously, yes. So yeah, once again, looking at these markets, you could say, look, this is so extreme already. Yeah, Nasdaq already on the green today, above 15k. So much in this wedge, so far from this double bottom we discussed 2 months ago. But then again, with this over liquidity, there is just no reason for investors to leave the party early until something major breaks. This is the way I would look at the markets right now. Okay, so with this in mind, let's take a look at the FOMC and other things that are in the pipeline today. So first of all, we have the FOMC meeting on this Wednesday. Obviously, they are not going to change their policy, but the market expects they will say something about the tapering, so the reduction in the pace of money printing or asset purchases, if you will. They announced in the past that they would say something in advance before doing something. So this is the time to do that. And yeah, I wouldn't expect big things, frankly speaking. Just less than 2 weeks ago, Powell was saying that he thinks there are still ways off from tapering, which is silly, obviously, with what we saw happening in the economy. But it looks like they're looking for any excuse not to do this. But still, the markets will be expecting something, that they at least will say, okay, we'll take the decision in September or something like this. So this is something you should be paying attention to on Wednesday. Other than this, I would say definitely earnings, because on the economic outlook, yes, we have US GDP on Thursday, we have PC inflation in the US on Friday, but I wouldn't expect these to be big movers, whereas this calendar is really heavy with Tesla today, Microsoft, Apple, Google tomorrow, Facebook on Wednesday, Amazon on Thursday. So really very, very heavy calendar. And yeah, obviously markets are stretched, and then the Nasdaq is really pushing higher. So all these stocks are really crucial to this market. So obviously, normally it's the way in the US that the consensus is low enough for these stocks to beat it. But the question is how this sentiment will react. So far as we can see, the markets were so eager to dismiss any sort of concern. So you could expect, well, this is another opportunity to react in a positive way, and something that we saw already on the smaller stocks like Snapchat or Twitter. But we'll see. This week is going to be very, very important from the quarterly season perspective. Okay, ladies and gentlemen, thank you for your attention. So like I said, busy week ahead of us. Please stick to our news section, where we try to cover all of the major developments of these reports or the FOMC meeting. You can be sure that you can be updated with our news service also in the mobile app. So stick with us, and we'll see each other next Monday. Have a great week.